Welcome to this ScreenSkills presentation on the Self-Employed Income Support Scheme, and in particular, its implementation in a media context. Now, my name is Ceri Stoner. I'm a tax partner at Wiggin, and Wiggin is a law firm which specialises in advising those in the media sector. Presenting with me today is my colleague Seth, who is one of our employment law specialists at Wiggin. Now, at Wiggin, in terms of looking at these rules, we've been working closely with both our actual media clients and also the umbrella organisations in media, and just reviewing the rules and the impact of these rules on freelancers within the industry. We are aware, of course, the importance of these rules and of the significance of getting these even slightly wrong for freelancers. So we've also been liaising with the Treasury, who've of course had to design and implement this scheme at what is, by policy standards at least, breakneck speed. So we've been feeding in comments and suggestions to improve the reach of the scheme and its work is sort of the way it works in practice. So the aim of this webinar today is to give viewers really the opportunity to learn more about the detail of the self-employed income scheme and its application to you within the media industry. We also want to recognise that there are those who, whilst some find its support invaluable, there will be some people who will not qualify under the scheme. So we'll be looking at identifying those groups of freelancers who won't benefit from the scheme. And in particular, we then want to go through the alternative support that might be available to those classes of people. And also, frankly, some of these alternative sources might also provide a secondary source of support to those who do qualify for the scheme. Now, as Kay said, this is intended to be an educational webinar. It's not legal advice per se. However, we do want to give you the chance to ask any questions about the scheme's features and also its shortcomings, as I suspect there'll be questions on both. As Kay says, you can submit questions as we go through the slides and also afterwards. And we will do our best to answer as many of these, probably primarily at the end, as we've time for. We've also a specific email address, so if you've got follow-up questions at the end, or if we don't get a chance to address your particular question, please do feel free to contact us afterwards. So to move on to the content of the talk, here's a slide showing the outline, and this is basically just a quick sort of helicopter view of what we're going to be covering. Initially, we're going to give you an introduction, and this will cover the key aims and policy objectives of the SEISS scheme, the Self-Employed Income Support Scheme, and so really sketch out its key features. We'll then be taking time to go through the eligibility criteria, so really looking at which freelancers will qualify for a grant. The next is the ineligible, which is a bit of a mouthful, but this is really important, and this is a look at those who are likely not to come within the scheme as it is presently drafted and constructed. And really just looking at these classes of people, just so people are aware whether or not they might fall within these. Then we're going to look a little bit at the detail of the amount, the quantum that those who qualify will receive under the scheme. So this is how much you can claim per individual. And then looking at the actual claim process itself, how to claim, and the follow-up really to that. They will then look at the other support. So this is for people who do qualify, but also primarily perhaps for those who don't. And this is really, it's not an exhaustive review of other available support, but it's just a run through of what is available, and just to give you an idea of what's there and an indication of whether or not you may qualify for this, and whether it's perhaps worth looking into this for you. Finally, we'll be looking at action points for individuals and their businesses, and also looking at what we're intending to do over the next few weeks. And then we'll move on to the question and answer session itself. So to begin at the beginning then, the Self-Employed Income Support Scheme, SEISS as I'll call it when I can, was announced by the Chancellor on the 26th of March. It's currently available for 3 months, although this period may be extended, obviously depending how things play out with the lockdown and generally the economy. It was introduced following the introduction of the Job Retention Scheme, which was for employees, and that was introduced on the 20th of March. But essentially, the Chancellor was under much pressure really to introduce something to support equally sort of supportive measures for the UK self-employed. So on the 26th of March, he announced a self-employed income scheme. The purpose of the scheme is really to address the financial difficulties faced by many self-employed freelancers in the UK as a result of the COVID-19. But note there are, as we mentioned earlier, some gaps in eligibility that we'll look into more closely in a moment. When the Treasury announced it, they did pronounce at the time of its launch that the scheme covers at least 95% of the UK's estimated 5 million self-employed workers. But for those 5% that are outside, or perhaps those who are unintentionally outside, clearly this can be painful. The design of the scheme itself is fairly simple. It basically allows eligible freelancers to claim a taxable grant of 80% of their trading profits. And these are essentially averaged over 3 years, but we'll look at the detail of the calculation in a moment again. There is a cap of £2,500 per month, which is the same as the cap under the job retention scheme for employees. And again, there is an initial period for the scheme that is set to run for 3 months. So for an individual who can have make a full claim, you're looking at £7,500 of payment in total from the government. As mentioned before, of course, this may increase as the time period is extended. So looking at the criteria and the implementation here, there's really 2 points to note. The first is that the eligibility criteria is stringent. So whilst this is a massive handout from the government, which will probably serve as a lifeline for thousands of freelancers in the coming weeks, the scheme's limitations has obviously, as I'm sure many viewers are aware, raised concerns. And there is a significant concern that the government will effectively be withholding substantive support from significant sections of the freelance population. Given the prevalence of the model, these freelance model in the sector, this could obviously have a significant impact on the UK's creative industry, which is why we really want to run through today the details of the scheme so people are aware where they stand in relation to this. The second point to note is a positive point actually, and this is that if a freelancer receives the grant, you can still take on other work and employment elsewhere. So there is some flexibility in terms of the implementation, so you can receive the benefit of this grant and continue to work, and including voluntary work in that, if you have the opportunity to do so. And finally, just one point to note when looking at the big picture in relation to the self-employed scheme is when it was introduced, the Chancellor also confirmed that the government intends to start a discussion on the different tax treatment of the employed and the self-employed. Now, as I'm sure any freelancer watching is aware, there are some benefits to having your own personal service company and taking your money through your personal service company, which, the tax system, the effective rate of tax is slightly lower overall. This is going to be subject to review as a quid pro quo almost of receiving the support from the government, I think, is the Treasury's thinking here. So I'll move on now to allow Seth to run through in more detail the eligibility criteria for the scheme.
Thanks, Ceri. So, yeah, like the job retention scheme that we discussed yesterday, there are fairly strict eligibility criteria in respect of the self-employed scheme, as Ceri has already addressed. Now, perhaps the sort of intention around the eligibility criteria for the self-employed scheme is perhaps slightly different to the job retention scheme. In the job retention scheme, a lot of the kind of eligibility reasons were around preventing fraud. And I think that that's potentially relevant to the self-employed scheme, but perhaps some of the criteria are actually sort of more policy driven in respect to the self-employed scheme, because it is obviously been quite a difficult scheme for sort of HMRC to put together, and they want to ensure that it's sort of hitting the particular individuals that they're targeting with the scheme. Now, in terms of what the criteria are, they are generally based on your trading period and when you've been trading, and also your sort of trading profits, and there's a trading profit threshold, which I'll come on to. Now, the first criteria is that you must have been self-employed and have traded in the most recent tax year, so the tax year 2019/2020. So that's the first sort of criteria. You also must have submitted a tax self-assessment return for the previous year, so that's the tax year 2018/19. Now, the reason this is important is this is the self-assessment return which HMRC will be using to essentially assess your eligibility under the scheme. Now, those sort of self-assessment returns should have already been filed. The deadline to file them has passed, but you may have been aware that when Rishi Sunak announced the scheme, he confirmed that there would be an extension of a month or an extra month for individuals who hadn't yet put in their returns to get those in. Now, that deadline on that extended period expires in 2 days, so on the 23rd of April. So if you are in that category and you haven't yet put in your self-assessment return for 2018/19, then you've got 2 days to do so to meet that extended cut-off date. Now, obviously, that's sort of 2 years of tax eligibility criteria to be aware of. There's also a future-looking criteria, which is that you must be trading at in the current tax year, or you would have been trading if it were not for COVID-19, and you must be intending to continue trading into the current tax year, so sort of throughout 2020/2021. So that sort of shows how it's almost a kind of a look back to sort of the previous 2 tax years, as well as a sort of a kind of a looking forward approach as to sort of assessing eligibility. It's also important that you can demonstrate that you've lost some trading profits due to COVID-19. So the eligibility is based on you being able to demonstrate that sort of the recent sort of shutdowns of productions, for example, has impacted your earnings, and that will be therefore sort of assessed as to whether or not you're entitled to a grant under the scheme. And then finally on eligibility is the trading profit threshold, which I mentioned earlier. So the scheme is only available if your trading profits are less than £50,000. And also you must have earned at least half of your income via self-employed work as opposed to sort of employed work during the relevant years. Now, in terms of how that's assessed, they will either look at the tax year 2018/19, which obviously they will have the tax self-assessment return for, because obviously that's one of the things they will have. Or if you fail to be eligible in that particular tax year, so for example, if you had a particularly profitable year during 2018/19, then you may still be eligible if they look at the average of your tax years 16/17, 17/18 and 18/19, and over the average of those years you come in under the £50,000 threshold. So there's a little bit of flexibility there, but obviously I think this particular criteria put together with the previous criteria, which requires a certain amount of sort of trading history, means that sadly there are going to be a significant number of individuals which won't be eligible under the scheme. Particularly the sort of higher earners within film and TV may find that they sort of fall outside the scheme, which sort of leads nicely on to the section that Ceri is going to talk about, which is sort of those who are ineligible and whether or not you might fall sort of outside of the cracks of the scheme. So I'll hand back to Ceri now to take you through that section.
Thank you for both. So yeah, this slide really just pulls together the results of or the impact of the criteria that Seth just trotted through. And as he said, just begin at the beginning, the first bracket of people who might not qualify for the scheme are those freelancers who are earning in excess of 50,000 per annum as calculated. So this profits criterion, on the face of it, is arguably fair, and it's not an unreasonable outcome from a policy perspective to provide a safety net perhaps for those freelancers who need it most. However, I suppose the question here is what happens to those who are in excess of 50,000. And when the Chancellor suggested the profits criterion and announced it, he suggested that actually the individuals excluded on this basis on average have an income of about 200,000. Now, from our conversations, we're aware that there are many who would dispute this, and many in the media sector who have stated that actually in excess of 50,000 isn't particularly high, especially for individuals who are perhaps London-based. So therefore, I think there is some lobbying going on at the moment and representations put into the Treasury and also to DCMS on behalf of the media industry, just to really make the case for those individuals, especially those who miss it by a relatively small margin, but who really would probably benefit hugely from having the support. So moving on to the second group of those freelancers who are outside of the scheme, these are potentially those freelancers who move regularly between pay-as-you-earn and self-employed engagements. And they may just fall into the gap between the two government schemes, or at least benefiting significantly from that. As Seth just said, you need to have a majority of your income from self-employment in order to qualify for this scheme. And under the job retention scheme for employees, you need to be under an employment contract at a certain point in time. So if you don't qualify under those heads, arguably you're left out in the cold. And this can be, depending on particular facts, this can be obviously very difficult. So I think if you're a freelancer who has a mixture of PAYE and self-employed income, I think you really need to look closely at the criteria under both schemes to see where you sit and where you potentially have an application for government support. On the third bullet point here, we've got freelancers who are running personal service company, which obviously are commonly known as loan-out companies, and which also operate PAYE systems. Essentially, this, as you probably know, captures many freelancers. So most freelancers with loan-outs do pay themselves a low salary and take out the majority of their income as dividends. And this historically has been the case simply because it's the most tax efficient way of taking the money out of the company, and frankly is permitted under the current UK tax system. However, this bracket of individuals are excluded from claiming under the scheme, and essentially that would probably leave you in a position where you will be claiming under the job retention scheme, so under the employee scheme, which itself provides up to £2,500 of wages per month. But if you've been paying yourself low wages, you will probably not qualify for that maximum amount and may therefore not receive the benefit you otherwise would. Again, this is something that there are many people in the industry and many people who are part of umbrella organisations are campaigning hard for at the moment, and really lobbying the Treasury to say, is it appropriate that now is the time to actually be addressing this particular pattern of behaviour? Should perhaps dividends and salary being taken together in the case of freelancers? Unfortunately, however, at the moment, the current rules are what they are. So we will see where the lobbying goes. But at present, if you are taking out wages as well as dividend income from your personal service company, you will be looking to rely on the job retention scheme for employees, not SEISS. Finally, there is the impact rules. There is essentially an exclusion for any new business. So any freelancer who was not self-employed as of the 6th of April 2019 will not receive any benefits under SEISS. Now, the policy rationale for that might be to prevent abuse, but obviously that's quite a long look-back period. So it does mean that new businesses will fall outside this, which is clearly a relatively large gap. The impact of these rules obviously will cause some confusion and some difficulties for individuals. It's important to work through all of these rules based on your particular facts. HMRC has provided guidance for this and examples on these in that guidance, so there is some detailed help. And as I said, there is some positives here. The first is that there is currently widespread lobbying, as I mentioned before, and HMRC is engaging and HMRC is listening to this. The feeling amongst, or at least my experience, and amongst some other tax advisors, is the focus has been a lot on the job retention scheme in the past couple of weeks, because clearly this has been a big issue, and the launch date was yesterday for the portal there. SEISS is a bit of a longer term benefit in that contractors will be contacted in in the course of May, and the payment made in a backdated way in June. So therefore, I think it's subject to ongoing policy review, and there's likely to be updates to the guidance over time. So it's important not only to listen to this webinar today, but also to stay in contact and monitoring the situation going forward. Secondly, as we mentioned at the beginning, there is support available for those who are not within the scheme, and these will include loan schemes and other government supported initiatives, as well as media initiatives, and we'll come to these shortly. So in the meantime, let's move on to looking at the amount of the grant. So thankfully, in the current world of complexity and uncertainty, the calculation of SEISS is relatively straightforward. So just to recap on the amount of the monthly grant itself, it's 80% of the average monthly trading profit, up to a maximum of £2,500 per month. So the SEISS calculation is taken as the average monthly taxable grant. It's calculated by reference to historic trading profit, as Seth touched on, and this historic trading profit basically takes into account the continuous periods of self-employment. So there's detailed rules on this and examples on this in guidance, but essentially we have tried to summarize this information in this table below, and that looks at, you work out where you are in terms of the column on the left, so how long you have in terms of a period of continuous self-employment to take into account. So if you've got 3 years, you can use all 3. If you've got 2 and 1 the last year only, up to 2018, 2019. It's important to note that if you've got 2 years of self-employment, but with a gap here in the middle where you were employed, you just take that final year as well. So essentially, you add together the total amount of trading profits for those 3 tax years, and then you divide it by the number of tax years applicable to you. So hopefully that table is a fairly simple summary of what's in the guidance. But as I said, you can certainly go and check the guidance directly yourselves at the end of this talk. So moving on to the next slide then, I'm just going to talk through how the SEISS grant itself is calculated. So first, you calculate the average annual trading profit by reference to the table before. So when calculating trading profit, HMRC is only interested in business income less the allowable business expenditure, so your office costs, staff costs, travel costs, etc. So you would ignore deductions such as pensions and for gift aid, etc., for the purposes of this calculation. So second, once you've done the annual trading profit, you then look to 80% of that profit, and you basically, the number that pops out of there, whether or not it is necessary to cap that, whether or not it's higher than the 2,500 per month allowed by the government scheme. So it's basically up to this 2,500 amount. As you'd expect, there are a couple of anti-avoidance provisions in relation to the scheme. In particular, any returns that have been submitted any returns submitted before the 26th of March 2020 will not be allowed to be amended and considered in determining eligibility or the amount of any grant. However, as Seth touched on earlier, there is a more generous measure. So if you are a late filer, so you've not yet completed your 2019 return, you have the chance to submit tax return up to the 23rd of April, which is actually this Thursday, so the day after tomorrow, as we're recording this live, and still be eligible for the scheme. So if you have got self-employed income for that 2019 tax year, it is important to file this pretty promptly. So moving on to look at the claim process itself, HMRC at present have actually asked taxpayers not to contact them directly for further details just yet. As I said, they're currently working on updating the guidance further as far as we are aware, and further information will be provided in due course, is the indication of the existing guidance about those who are unable to make a claim online will be able to apply. But HMRC has said in the meantime that it will aim to contact eligible freelancers during the course of May. So really, I think the indications are from mid-May onwards, and you will then be invited to claim SEISS using their online services. So once you've received a notification from HMRC, you will then be able to calculate and submit your claim based on the average trading profits. HMRC will then review this, and once an individual's claim is approved, they will contact the individual again to confirm the quantum that will be payable. The payment itself, which will be made in one instalment, covering as much time, but probably all 3 months of the scheme, is expected at this stage to be in early June. So that is the current pay date. Obviously, this may leave a slight cash flow issue for some people in the meantime, but those are the current rules, and clearly this is quite a complex scheme to administer, which I think is why it's taken a little bit longer than the job retention scheme to be published and now to be finessed. Now, it's important to note that the grant that any individual receives from this scheme will itself be subject to income tax and national insurance contributions in the hands of the freelancer. However, it's also important to note this is a grant and it's not a loan. So those who do receive the grant do not need to repay the government. In terms of those individuals who are not contacted by freelancers in mid-May, I think, by at least the end of May, we're expecting there to be clarification on a sort of a process that they can follow if they believe that they are entitled to benefit from the scheme. But we are again awaiting details on this, so it's really a question of watching the space on that one. So now we're ready to move on to really looking at the other support that is available if you are not one of the freelancers who can benefit from SEISS. So I'll pass over to Seth for this.
Thanks, Ceri. So yeah, unfortunately, obviously there will be a group of individuals which aren't eligible for the scheme. And in terms of what else is available, well, there's a few things that you should be aware of, some industry specific and others which are available to sort of people generally. The first one worth highlighting is alternative work. Now, this is particularly relevant because it actually wouldn't jeopardise a claim under the SEISS anyway, and actually potentially wouldn't jeopardise a claim under the JRS either, provided you sort of have sort of consent for your employer. But that's a sort of a slightly different issue. But obviously, with a lot of production work having shut down, being able to find work within the industry might be quite tricky, but that doesn't mean that you couldn't potentially go off and find other paid work, which is possible even in the current lockdown measures, because work can be done, and you're only required to stay at home if actually you can do your work from home, and you can go off and work elsewhere outside of the home if necessary. So alternative work is obviously something that we would suggest that you look into if possible. Ceri mentioned earlier the job retention scheme generally. It's possible that you might be eligible for that. So it could be in a situation where you've done some work via PAYE and your prior employer, or if, for example, you're a statutory director on a PAYE scheme, the employer that was engaging you in that capacity may be able to enrol you on the JRS scheme, and you may be able to get reimbursement of sort of salary in that respect. It's also possible, as Ceri said, that if you're a loan-out company who operates your own payroll, then you may have a claim yourself that you could make through the job retention scheme as well. So the job retention scheme shouldn't be discounted, but obviously it will only apply in limited circumstances. Insurance cover is also worth checking out. So obviously most self-employed businesses will have some form of business cover, and it's worth checking your policy details quite closely to see whether it would cover sort of damages and loss in connection with sort of pandemics. Now, sort of our kind of initial sort of feelings on this would imply that actually a lot of sort of general business cover won't necessarily cover loss of profits due to pandemics. So the actual amount of claim, even if your policy does cover pandemics, may not cover that much, but it's certainly worth having a look into that. Although it's interesting that the Association of British Insurers Association indicated that they felt that most small businesses only have very basic cover, which wouldn't necessarily cover pandemics. But obviously that's something that you'll be able to look into yourself and have a look at. Next up is kind of welfare benefits. So I'm going to look just very, very briefly, because we're not really sort of welfare lawyers at Wiggin, but just what is out there. And firstly, you've got the Employment and Support Allowance, or ESA. Now that is a benefit that's available for individuals that can't work due to a health condition or a disability. And this has been extended a little bit under the sort of COVID-19 crisis, so that it will apply if you are effectively suffering from COVID-19 or the symptoms of COVID-19, or if you're self-isolating, and even if you're one of the individuals that's shielding. So if you're an individual in a high-risk category with a health condition, or if you're over a certain age and you've been told to stay at home for a sort of the 12-week period, then potentially ESA could be relevant as well. Now, ESA pays out a kind of a certain amount depending on your circumstances, but it's roughly sort of £100 to £115 a week. And it's obviously sort of something that you could look into to see whether or not you'd be eligible. And then finally from me, on terms of other support before I hand back to Ceri, is universal credit, which is the other sort of key welfare benefit that's available now. Universal credit is effectively the benefit that's available for those who are seeking work. Now it pays out at around £350 to £410 a month, but that's for a single applicant, and then it can be increased depending on whether you're a couple or you've got children, etc. So potentially the amounts will vary, and you can find more details online around that. And there's also certain eligibility criteria around accessing universal credit. But it's worth kind of bearing in mind, I saw there was a question already raised on this, you can access universal credit while you are waiting to see if you're eligible for the SEISS grant. But it's worth just bearing in mind that your earnings and sort of details that you may have sort of filed in respect of your self-employed position may affect your sort of claim under universal credit. Now, there's a few other things that have been announced in terms of universal credit to try and improve it a little bit at this time. So the minimum income floor has been suspended, and effectively what this should mean is that the self-employed accessing universal credit can do so at an equivalent rate to statutory sick pay for employees, although, as I'm sure many of you will know, that's not a substantial sum. The standard allowance has been increased by £1,000 a year, so that is a sort of a material change to increase the amount that you can get under universal credit. And they've also sort of changed the way that you will apply for it, so there's no longer a need to actually attend a job centre to sort of show that you're seeking work. You can sort of have telephone interviews and things like that. So universal credit is something that's worth looking into. Probably isn't going to be the ideal solution for many, but it's certainly something that you should be doing if you're in one of the categories where you can't get other support. So just handing back to Ceri, there's a few other things in terms of other support that might be available for you.
Thanks, Seth. So just a quick run through of these three potential sort of support measures that may be applicable. Just sort of really on awareness, so we're just going to touch on these to ensure that you know they are out there, and so you will be able to check yourselves if they apply. The first is business grants. If eligible, there is some funding available under the Small Business Grants Fund or alternative fund that may not be so applicable immediate, but the Retail, Hospitality and Leisure Grant Fund. So depending exactly what you do, it'd be worth checking these. There's also a local authority support in the form of a hardship fund, which is being used in most cases, and it will vary according to your local authority, but to provide council tax relief. So that's another possibility in terms of help with your personal position, and also the mortgage holiday scheme, where the government has confirmed that those mortgages will be offered at least a 3-month mortgage holiday. So those are just a really quick run through before moving on to the next slide, which is possibly more sort of in our line of work, as it were, which is the Business Interruption Loan Scheme. Now, there are two schemes available, one for small and medium-sized businesses. That was announced first, and then subsequently, there was a later scheme that was announced, which was the larger business scheme. for loans to bigger businesses. So the first of these applies to small and medium-sized businesses with an annual turnover of up to 45 million. And this basically provides these companies with access to finance. So that can be any form of debt, really, loans, overdrafts, invoice finance, asset finance, etc. But the maximum loan is 5 million, and the maximum term is 6 years. Now, the scheme is delivered through commercial lenders and is backed by the government-owned bank, the British Business Bank. And this is important in terms of two things, really. The first is that the government will provide lenders with a guarantee of 80% of each loan. But the second is that it does mean that as business owners, it's quite likely you'll be required to provide a guarantee for the remaining 20% of each loan. And this, I think, has been left as it was initially announced and not pushed up to a government guarantee of 100% in order to ensure that basically business owners have some skin in the game and don't just take out loans that are too large, and also to ensure that actually the commercial lenders themselves provide proper checks and balances on this, a proper DD, rather than just lending to anybody who applies. The terms are good of the loan, however, in terms of the government has also made available a business interruption payment to cover the first 12 months of interest payments. So they will cover the interest costs for the first year and any lender levied fees. So this essentially means that smaller businesses will benefit from no upfront costs and lower initial repayments. In terms of eligibility for small businesses, you need to be based in the UK, have an annual turnover of up to 45 million, and you need to self-certify that your business has been adversely impacted by coronavirus. Now, I've seen that there's been a number of questions about this, and it's really the same for the context of, I think, the self-employed income scheme as well. How do you prove that you've been adversely impacted? When you're looking at future contracts, it's obviously quite difficult to prove the negative, i.e. that you didn't get work that you were expecting when you don't have that contract yet. However, I think HMRC and the Treasury are going to be reasonably pragmatic here. And clearly, if you've got a track record of working a certain amount of time per year, it's reasonable to expect that had COVID-19 not happened, you would have worked that amount of time for this period coming. So I think you simply need to show your trading profits for the previous years, and the fact that you have no work now or reduced work now, and the fact that you have no contract and there's no money come in should evidence the fact that you've been affected by COVID-19 in both the context of these loans and also in the context of the SEISS too. I won't go through the detail of the large business loan simply because it's business turnover of more than 45 million. They have access to loans, larger loans of up to 25 million, and that's really the headline here. In terms of the actual criteria, it's quite similar, but it's also quite detailed and will depend on the terms put in by the commercial lenders, which will be on a case-by-case basis. But essentially, again, you've got to be based in the UK, meet the annual turnover criteria, and amongst other things, self-certify that you've been adversely impacted. So moving on finally to the final amount of support, and this is from the government, and this is really looking at tax measures that have been introduced to assist cash flow over the coming period. So the first of these is the deferral self-assessment income tax. And in particular, this is looking at the instalment payments that are due during the year. So these are the payments on account that individuals make, usually in relation to sort of the first part of the year. So because of coronavirus, you can now delay making your second payment account, and you have until the 31st of January 2021 to pay it. You can, if you wish, also pay regularly through the year if that's easier for you, and you can basically agree a budget payment plan with HMRC. So the thrust of things here really is that HMRC allowing some delay and some flexibility in terms of how you pay your income tax. There's also deferral of VAT payments to help businesses manage cash flow. So if you're UK VAT registered and have a VAT payment that's due between the 20th of March this year and 30th of June, you also have the option to either defer the payment until a later date, or of course you can choose to pay as normal should you wish. There are a couple of carve-outs to that, so it's worth checking the details, but that's the main thrust of the rules. And again, there's additional info every time to pay. So time to pay was previously used in response to flooding and the financial crisis. And essentially it provides businesses with a time-limited deferral period generally on HMRC liabilities owed, and a pre-agreed time to pay this back. And I think the pre-agreed is the really important part here. Don't just not pay, you need to communicate what you're doing and why. But essentially you can reach a sort of tailored arrangement with HMRC that will give you the time you pay, reasonable amount of time to pay HMRC to support your recovery. So there are thousands of call handlers who are on a helpline to help discuss this and how it might perhaps help your businesses. HMRC will also waive late payment penalties and interest clearly where there's been admin difficulties contacting HMRC or paying taxes due to COVID-19. And again, you would have evidence that had happened. So moving on to Seth now, I think just look at a couple of media specific support options available.
Yeah, just very briefly on these. So the COVID-19 Film and TV Emergency Relief Fund is worth knowing about. Now, this is an industry-specific fund which has been funded by various large organisations in the industry: Netflix, BBC, Warner Brothers, Sky, etc. And it's aimed at effectively providing short-term relief to individuals who've been affected by COVID-19. Now, it'll provide one-off grants of between £500 and £2,500. But the most important thing for you to bear in mind with this is that the scheme opened on the 8th of April and it closes tomorrow at 6 p.m. So 6 p.m. on the 22nd of April. So bear in mind that if you are planning to access this fund, then you will need to do so urgently. Now, there's certain criteria around this which aren't that dissimilar to some of the government schemes. You need to show that you've been working in TV and film. You need to have shown sort of a history of working in the industry and show that you've effectively had a contract cancelled due to the pandemic. You need to have been suffering financial hardship and have less than £2,500 in savings. Also, you won't be eligible. Sorry, you can only access this if you're not eligible for the SEISS, unless your SEISS grant is likely to be very low. Also, you can't access this if you've been furloughed. But it's worth having a look into if you don't think you're going to fall within the SEISS in particular. And then finally, there's also the Equity Benevolent Fund, which is just for equity members who are effectively facing financial difficulty due to COVID-19. Now, this effectively is a grant to pay sort of one-off expenses, and the grants are between £60 and £350. So relatively small sums, but it's another fund that's available. So I'll just hand back to Ceri now, who's going to wrap things up, and then we should have a bit of time for questions.
Just 30 seconds for me on this really is just self-employed individuals, just look at the eligibility. The takeaways from this talk is look at the eligibility criteria, continue to monitor that criteria over the next few weeks. And especially right up until the point where you are receiving or not receiving communication from HMRC. And also look at it from your business perspective as well, in terms of the business grants and loans, as well as the personal benefits. So we're just going to take 10 minutes now just to very quickly address some of the questions that have been coming in. I'll start by taking a few that I've had a quick look at, and then maybe Seth can sort of step in a couple of minutes with some more that he's had a chance to read. Essentially, a lot of the questions that I've had a look at seems to go to how you evidence loss of earnings, as I said. Now, essentially what HMRC will do ultimately when in the fullness of time, when they review whether or not you should have had the money or how much, they can ask basically for a disclosure. So in terms of evidencing contracts that you've not gone ahead with, if you've got emails to that effect, you should be saving them, making sure you file them really as your contemporaneous evidence, as well as I mentioned earlier, just having the accounts and the record of your income to date, so you can clearly point at what you have been receiving last year, what you have been receiving in the previous 3 years, just so that should anyone ever ask, you've got spreadsheets, you've got the information available. One of the other questions that was raised was, how will HMRC communicate with you? Now, they haven't actually formally said, Usually when you submit a self-assessment return, you elect as part, if you're doing it online, you elect your preferred medium of communication. So it would be perhaps by email, it might be by a hard copy letter. Now, given the importance of the scheme to so many people, it might well be a letter form for this in any case, but it might be that they go with your preferred elected sort of medium of communication that you've selected. So it would be worth logging onto your account and just having a look at you know, how you've asked them to communicate with you and how you permitted them to communicate with you, and then obviously monitoring, you know, junk inboxes, etc., during the time from a very sort of boring practical level to make sure you don't miss something. Also, I think there was a couple of questions about tax returns that weren't done or weren't accepted. I think if you've submitted a tax return and you've had communication to say that it's not valid for any reason, I think you've got a window now until Thursday to submit a valid tax return for the year end 2019. So as you know, normally the cut-off period would be the 31st of January, but I do be clearly aware that there's been an extension in this particular case. So now is the window of time to go back and try and submit one correctly. I expect most people are doing it online nowadays, so this should still be possible. And if you're having any problems there is a helpline to submitting your tax return. And if nothing else, at least send an email to HMRC with what would have been your tax return if you are a hard copy filer. So at least they have that current information. I mean, a lot of HMRC officers are working from home, as are most of us. So email is not a bad medium of communication rather than sending in a letter at the moment. Seth, do you want to pick up some questions you had a chance to have a look?
Yeah, of course. Thanks, Ceri. So there was one early on around, can I confirm that if I earned under 50,000 in 18-19, but my average over the 3 years was over 50, will I still qualify? Yes, I think is the answer to that. So they're looking at either the 18-19 year or the average of the 3 years. And I think the intention behind the scheme is that you wouldn't fall outside if one of those wasn't sort of under 50k. It's either or effectively. So I think you'll be fine in that situation. There's a couple of questions from individuals who've said that they obviously started working self-employed relatively recently. Will they qualify? Unfortunately not, as Ceri said, the sort of eligibility criteria are quite strict in terms of historic self-employment. So unfortunately, that is tricky. There's a question about someone who works on sort of daily contracts fairly regularly, more PAYE work, and they're sort of struggling to see where they fall into all of this. I think with dailies, sort of daily hires on film and TV productions, you would expect those to be PAYE rather than self-employed, and it's likely that if you were on the payroll by the relevant cut-off date, then you may well be eligible under the job retention scheme. So that's probably where you fall. The problem with daily contracts is that you will be a variable pay worker, so the amount that you can, or your employer can potentially claim under that scheme, will obviously be based on your average earnings for that particular employer. So it may not be a substantial amount that can be claimed for you under the JRS, but I would have thought that provided you've hit the relevant cut-off dates, it's the JRS that would be relevant in that situation.
And it is worth adding just to that you can only make one claim under JRS. So if you are receiving multiple, have had multiple employment contracts, you can only have one employer who claims JRS in relation to you. So whether that's your personal service company or whether that's your actual PAYE, engager, third party, just need to sort of give it some thought and make sure that you don't make multiple claims inadvertently.